Hello, I hope you're all doing well. I'm Rick Basinski, Chief Economist at IBISWorld. Welcome back for those of you who tuned in to my previous podcasts and webinars, all related to the economic and financial impacts of the COVID-19 pandemic. Today is episode 9 in this series. Like my last webinar, I'll focus on the labor market and the recent surge in unemployment. This is a new set of episodes analyzing the COVID-19 pandemic, but thematically consistent with previous installments. The objective is to analyze in detail which occupational segments will likely rebound quickly and which will lag behind a general recovery. The endgame being to assess credit quality for both consumer and commercial lending and take a look at state and local government financing. Today, as promised, I'll take a quick look at manufacturing. As a reminder, here's the basic architecture of how I'll structure the next several webinars, looking at how unemployment influences 3 separate lines of credit and what is the relative degree of these impacts. For commercial credit, I'll consider C&I, CRE, and agricultural lending. For consumer credit, I'll entertain home mortgages, consumer loans, and credit cards. And finally, in regards to state and local government financing, I'll discuss the bond market, but this will come later next week. As I mentioned, I'm going to disentangle this in a very disaggregated, granular way in forthcoming weeks. So you may want to take some notes here. I borrowed this chart from my last webinar as a point of reference, showing the unemployment rates by sector this April compared with a year earlier. The red line defines the demarcation of a 10% unemployment rate. Like rocker Rod Stewart wrote, doesn't every picture tell a story? And a sad one for workers in leisure and hospitality, also retail trade. As you can see, not happy times either for workers in some professional business service areas or in construction. Today we'll deal with manufacturing employment, looking at durables, stuff like autos and refrigerators, versus non-durable goods, things like toothpaste and other consumer household products. We're going to get very granular at times, drilling down to even a 5-digit NAICS level. As you can see from this figure, durables track non-durable unemployment rates fairly closely during normal non-recessionary times. But when times get tough and manufacturing is highly stressed, durable goods employment gets hammered. People just don't buy as many big-ticket items during economic downturns, and employment in this sector suffers immeasurably. Check out the rectangles on this chart. One represents the Great Recession, the other our current situation. In short, during recessions, credit quality will erode considerably for companies and their workers involved in the manufacturing and trade of durable goods. This is simply not the case, at least to not this degree, for non-durables. Here are the unemployment rates from the most recent BLS release for durable goods manufacturing. Note the April year-on-year numbers, the differences between April 2020 and 2019. I'm going to deep dive on the 6 areas indicated by the red arrows, as these trouble me the most. Let's consider transportation equipment. This table shows the average annual rates of employment growth or contraction for 2 periods. The first, the last serious spike in unemployment, the 2009 to 2011 period, and the start of the recovery phase, 2012 to 2014. Typically, transportation-related sectors are in relative sync with economic cycles. Hence, the so-called shape of our pending recovery will help determine the performance of employment in this arena. However, I wonder about automobiles. The largest U.S. manufacturers started reopening plants this week. But along with supply chain and health safety issues, there is simply a question of demand going forward. Note that the global auto industry was in a situation of oversupply even prior to the COVID-19 crisis. These factors and uncertainty regarding the economic recovery may indeed continue to haunt car makers and their employees. The 2 arrows on this table identify other areas of employment risk. Not much needs to be said about the airline industry. Who knows if all major carriers burdened with debt will even survive the current crisis. And items like boats are highly discretionary spends, and these are often laggards during economic rebounds. Let's take a look at employment in furniture and related manufacturing. Historically, these are very hard hit in recessions and have quite spotty recoveries. They're highly tied to housing starts, and the prognosis for these isn't particularly that rosy. Plus, office furniture hiring is not likely to rebound quickly this time around, and perhaps working from home may become a trend. As for machinery manufacturing employment, this also falls rapidly during bouts with waning economic activity. Check out the sharp declines experienced during the 2009 to 2011 period. And the prospects for rehirings for construction and oil machinery manufacturers probably won't mirror the recoveries of the past. By the way, remember, we had spikes in oil prices in 2011. Not likely to see this in the foreseeable future. The next two slides cover areas I reviewed from a slightly different perspective in episode 4 of this series. So you may want to cross-reference these if you have exposures in these businesses. Here's a table on employment in primary and fabricated metal products. These are intermediate durable goods used in many manufacturing processes. As such, they are driven by industrial production, the national average of which has crashed down 11% in April and 15% from a year earlier. So how fast factories return to fuller capacity will determine the fate of employment here. The industries I circled on the table are ones I considered poorly positioned for recovery in my episode 4 webinar, owing to either high volatility or international trade exposures. Hardware manufacturing has import competition issues as well. And we all know about the trade issues involving iron and steel and aluminum. Here we have non-metallic mineral products, much like employment in primary and fabricated metals on the previous slide. These are intermediate goods that are heavily influenced by industrial production. The employment declines were catastrophic during the Great Recession. Check out this table. Once again, the industries I circled on the table are those I judged to be relatively poorly positioned for recovery in my episode 4 webinar, owing largely to high volatility and/or international trade exposures. Plus, many of these industries were on the decline prior to the COVID-19 crisis. Not to rain on the parade of employment prospects in this sector, but the risks just can't be ignored. Consider employment in miscellaneous product manufacturing. Miscellaneous groupings are more often than not a hodgepodge of seemingly unrelated industries, such is the case here. Note that many of these in this group are discretionary spending, so employment expectations going forward aren't particularly cheery for these. Medical equipment and suppliers have some big-time players like Johnson & Johnson and Stryker Corporation, but there are many small operators in this space. I put a green arrow here since I think employment growth will be solid for this group. I feel the same way about game manufacturing for obvious reasons. There are industries that have benefited from social distancing. Let me briefly turn to employment for non-durable products. Here are the unemployment rates for April 2020 and April 2019. The green arrows here are fine by me. Yellow, there are some provisos, tobacco being one. Red arrows, these are pretty obvious. Textiles are a small share of non-durable production, as much of this was sourced overseas decades ago. And I don't think I need to comment on petroleum and coal, as I have in previous webinars, but I will rummage around in basic chemicals. Tabled here, we have employment in plastics and rubber products. This group gets smacked harsher during recessions than most non-durable employers, and they tend to recover more slowly. Plus, as circled, some are joined at the hip with the auto industry that I discussed earlier. And finally, consider basic chemical products. Again, this group gets whacked harder during downturns than most non-durable employers, and they tend to recover more slowly. The circled industries are referenced in my episode 6 webinar, and I believe are not well positioned to fully enjoy the fruits of a general economic recovery. That's it for today. Thanks for joining, and happy Memorial Day. Stay safe and Godspeed.